Thank you everyone for joining our webinar this evening. If it's your first time here, welcome. I'm Hilda, Content Manager at the DEO, and today we're unpacking the complexities of DSO and private equity deal structures. So whether you're looking to sell or just stay informed, you're in the right spot. So grab your favorite beverage and your notebook, as Brandon will be breaking down the top deal structures commonly seen in today's market, the pros and cons for each type, and market trends to keep you up to date on buyer demand, recap events, etc. Brandon, I think we're ready to get started, so I'll let you kick us off and introduce yourself.
Awesome. Thank you, Hilda, and thanks for joining us. So this evening, I'm going to be talking about DSO deal structures and also be talking a little bit about current trends in the marketplace. Always like to start all my presentations with talking about kind of where we've been and where we're headed from a consolidation standpoint. Just a little bit about myself and my firm. I'm Brandon Moncrief, Principal CEO of McLaren & Associates. I've been in dentistry really my entire adult life. I spent about a decade as a banker lending money to dentists all across the country to buy, start, and expand practices. And then 13 years ago, I purchased McLaren & Associates. And at the time, kind of a small mom and pop practice brokerage company, really focused on doing private practice sales. But being headquartered in Texas, we were kind of on the forefront of a lot of the DSO and private equity consolidation that was happening in our space. And about 5 years ago, we built out a team and a process to provide sell-side advisory for large practice owners and emerging DSOs that are looking to pursue a DSO affiliation or private equity partnership. We serve clients nationwide. I'm coming at you this evening from Austin, Texas. That's where our HQ is, but we also have offices in Atlanta and San Diego. So truly coast to coast, serving all different types of dental practice owners, both general dentists as well as all specialties. We've been around 35 years. We've sold over 1,500 practices, representing over 1.2 billion in closed transaction volume. So we've been around the block a few times, have seen everything that can go right and go wrong with both private practice sales and DSO and private equity transactions. So with that, I'll hop right in, starting off talking about current market conditions. I think as everyone's aware, private equity and DSOs were operating with ideal macroeconomic conditions up until about 18 months ago. Historically low interest rates, unfettered access to leverage, to bank debt, and private equity had a ton of dry powder, a ton of cash available to deploy. So going into COVID, dentistry was arguably the hottest vertical that private equity was investing in. And then coming out of COVID, once dentistry rebounded very, very quickly following the pandemic, private equity doubled down. Those DSOs that were already in the space started acquiring practices at an even faster clip. And those private equity firms, family offices, financial buyers that were eyeing an investment in dentistry pre-COVID pulled the trigger, bought a platform, and began building a DSO. So we had about 200 DSOs operating nationwide pre-COVID. Now we're over 500 DSOs operating nationwide, with new platforms being formed every day, many of which are being formed by DEO members that are entrepreneurial and have built up a multi-site, multi-doctor, multi-million-dollar revenue business, and are eventually going to look to take on some type of institutional capital and continue to scale that business into the future. But as we all know, macroeconomic conditions have changed pretty dramatically over the past 18 months. Interest rates have doubled, tripled in some cases, and access to capital has been restricted for some institutional and strategic buyers. So a remarkable change from a macroeconomic standpoint that has wreaked some havoc in the private equity world and in the DSO space. So everybody that is using leverage to fuel growth, and that's how institutional buyers build DSOs, is under some sort of pressure at the moment. Interest rates are definitely weighing on cash flow. They're weighing on bank covenants. They're weighing on EBITDA margins. And it's harder to get access to capital. And when you can access capital, it's being lent at reduced rates, comparatively speaking, to where we were 18, 24 months ago. So as a result of those changes in the macroeconomic environment, this has been kind of the ripple effect. Demand and valuations have cooled off on the upper end of the market. Large platforms with EBITDA of 5 million or more, there's not as much demand, and valuations have been under some pressure. On the lower end of the market, practices with EBITDA of under $500,000, there is not near as much demand, and there's been some pressure on multiples. But in the mid-market, practices with EBITDA of 500,000 to 5 million, Class A assets are still trading every day and for favorable valuations. There has not been a marked change since valuations peaked post-COVID when we're talking about Class A assets in the middle market. So for those that are partnering with a strategic buyer, an existing DSO, most of them are trading in the 7 to 8.5 times EBITDA range. And for larger platform investments with EBITDA under 5 million, they're trading in the 8 to 10 times EBITDA range. So still a very healthy time to take your business to market if you're considered a Class A asset, you've got things dialed in from a EBITDA margin and efficiency perspective, and you've built a great business with a great reputation. You're willing to stay on and stay involved in that business long term. There are buyers out there, they continue to bid at favorable valuations. But some of the havoc that higher interest rates have wreaked on the market has put some DSO buyers on the sidelines. They're either over levered, they've tripped their bank covenants and don't have access to fresh powder to bank debt, or they're over their skis operationally. They grew a little bit too quickly post-COVID, and they weren't actually integrating and operating the practices they were acquiring. So they're at a point where they need to catch their breath, either financially and or operationally, and allow their infrastructure to and operations to catch up to the growth that they've experienced over the past few years. Now, while we've got probably a third of the legacy DSO buyers on the sidelines not buying practices, that gap has been filled by, younger emerging DSOs that have recently taken on institutional capital, still have plenty of access to both cash and leverage. They've stepped up to fill that gap, and that's why we really haven't seen a marked change in valuations for Class A assets in that middle market. Same-store sales growth has become a huge talking point, especially when institutional investors that buy these DSOs at recap are evaluating the opportunity. So in other words, they're talking about, great, you've proven that you can aggregate EBITDA, you can buy practices, but are you actually making the practices that you buy better, right? Are you growing top-line revenue? Are you increasing EBITDA? Are you leveraging economies of scale and driving down overhead? So same-store sales growth is a huge talking point in our industry at the moment. So focusing on year-over-year growth from both a revenue and EBITDA perspective is critically important. Investors at Recap are scrutinizing the businesses far more than ever before. They're looking, how has the business as a whole performed? How has each practice performed at the practice level? What type of infrastructure has the DSO built? Are they a real company that truly supports the practices they're partnered with on a daily basis? And is the company set up for long-term sustainability, both from an operational perspective and from a deal structure perspective? Are incentives aligned between the DSO and the partner doctors, both globally at the parent company level and locally at the practice level? Because of the fact that some DSOs are over their skis operationally or over their skis financially, because of the fact that it takes a tremendous amount of debt typically for an institutional buyer to buy a large or medium-sized DSO. Recaps over the past 12 to 24 months have been delayed and or muted. There's been quite a few DSOs that have went to market in an attempt to recap, either couldn't find a suitor or couldn't find a suitor at the EBITDA multiple they were looking for to create the arbitrage that their investors are expecting. So as a result of some DSOs not being able to find a new financial sponsor or not being able to achieve the type of return they were looking for, they're being forced to raise additional capital to, in lieu of recap, refinance their existing debt, get a new line of credit so that they can continue growing their business and acquiring practices. What we're really dealing with right now is a standoff between the financial sponsors of DSOs, the private equity firms, the institutional investors that currently own the DSOs, and the buyers and banks that acquire these DSOs at recap. So it's going to be interesting to see who blinks first, right? Are the sellers, in other words, the DSOs that are looking to recap, going to adjust to the new norm and be willing to monetize their organization at a 10, 11, 12x EBITDA multiple when their expectations were born in a completely different macroeconomic environment where their PE sponsor thought they were going to get a 14, 15, 16x return at recap? Or are the institutional buyers and their banks going to step up and say, hey, we're confident that dentistry is going to do well long term. We're willing and able to pay, 13, 14 times EBITDA in order to acquire this asset and continue to grow it and consolidate the industry. So I think there's going to eventually be kind of a meeting of the minds here in the back half of 24, front half of 25, where DSOs can fetch maybe not the multiple they were looking for when they were born, 5, 6, 7 years ago, but an acceptable multiple that's going to create arbitrage for their investors and their financial sponsor, where the buyer is going to be able to secure enough debt to get that transaction over the finish line and be in a position to be successful financially long term into the next iteration of that organization. So, despite the fact that the macroeconomic conditions have been a little shaky over the past 18 to 24 months, we're seeing more sell side activity than ever. I think that's a product of, a lot of people have built large multi-doc, multi-million dollar, multi-site businesses, and they want to monetize those businesses when the market, still has strong demand at strong valuations for what they've built. For a lot of our clients, their dental business is by far their most valuable asset. And they've got, 80, 90% of their net worth tied up in their business. They want to be more diversified. They want to take some chips off the table and diversify their wealth across multiple asset classes rather than having it tied up just in their business. And then I think a lot of sellers have realized that they need a sell-side advisor. They don't know what they don't know. Now more than ever, being that it's a bifurcated market of the haves and have-nots, it's important that you're doing diligence on the buyers in the marketplace and that you're creating as much optionality as possible, not only to maximize the economics, but also make sure, you partner with a DSO or financial buyer that's in the position to perpetuate your culture and your brand and protect your business long term, and then provide the runway to get to that second bite of the apple, that recap event at a handsome return within a reasonable period of time. So diligence on the health of the buyers that are bidding on these practices is more important than ever. And we spend an inordinate amount of time vetting and onboarding new DSOs that are looking to buy our clients' businesses and new financial buyers that are looking to invest in a platform. As I mentioned before, there's been steady buy-side demand for larger practices with EBITDA of over 500,000, particularly those that have multiple providers and strong growth potential, and where the founder and or the seller is a relatively young doctor that's got significant runway to go until they exit the business. We've recently closed multiple transactions at EBITDA multiples of 8x or higher. So the EBITDA multiples still look good for high quality assets. But again, I'll reiterate, now more than ever, you've got to have a strong team of advisors to help you navigate this process because it is complicated. There's a lot of moving parts, and we've got to look at, how the macroeconomic conditions have affected each of these buyers and impacted their ability to be successful long term. The last thing you want to do is sell your business to a buyer that's not well positioned, might be over levered. You're the last deal that they have money to get done, and then they go on a pause, for 12, 24 months, and your equity value suffers as a result. So what does the future hold? What is the next 12 to 24 months going to look like? This election reminds me a lot of the last election. Ton of uncertainty, entering this election cycle. I think most people feel like, neither option is a great option. So we're kind of having to settle for the lesser of two evils, depending on what side of the aisle you fall on. But there's no doubt a lot of uncertainty entering this election cycle. We're expecting that the market, from a macroeconomic condition perspective, will continue to tighten over the next 3 to 6 months. There has been some indication that there's going to be at least one, if not several, rate cuts in Q3, Q4 of 2024, leading into 2025. I'm really hoping that happens. But inflation was running a little hot in the last report, and the Fed started to walk back that rhetoric about cutting rates. I'm still optimistic that we're going to have one or two rate cuts in the back half of this year or Q1 of 2025. If and when that happens, I think we're going to see the banks relax a little bit. We're going to see the capital markets open back up a little bit. And that's when we're going to see quite a few DSOs recap in the back half of this year and front half of 2025. So that'll be a really exciting time, I think, for the industry. PE and banks will eventually adjust to the new norm, as well as, I think, the financial sponsors of the DSOs that are looking to recap will also adjust their expectations to the new norm and understand that they might generate a 3 to 4x return on invested capital, but the days of generating a 6, 7, 8, 9x return on invested capital for the time being are probably over, because rates are not going back to where they were 36 months ago anytime soon, possibly not again in our lifetime. I think dentistry is going to remain a very hot industry for private equity to be investing in. So I'm not expecting institutional financial investors to back away from the dental industry. This is one of the most profitable and stable, healthcare businesses there is. So I do expect for PE interest to remain very, very strong in dentistry for a long time to come. Dentistry will continue to consolidate. I think we'll reach 60% consolidation over the next 7 to 10 years. I'm always asked, like, where are we at in the cycle of consolidation? How consolidated are we? And you'll hear a lot of people say, we're 30%, we're 35%, 40% consolidated. I think that's a little naive. I don't think dentistry is near as consolidated as the DSOs would lead you to believe. Yes, there are practices selling to institutional investors and strategic buyers every day, but there's also young entrepreneurial dentists that are starting practices from scratch or buying practices every day. So I don't think the industry is being consolidated as fast as others may believe. I think we're somewhere around 20% consolidation, and that's going to continue to go up by approximately 3 to 5% a year, possibly a little more if we see interest rates come back down and the capital markets open up. And then with this election cycle, as we had in the last, there's the returning threat of an increase in capital gains taxes. I saw in an article just a couple of days ago that Biden has it on his docket, if he gets reelected, to potentially phase out capital gains treatment and everything move to being treated as ordinary income, which as a business owner would make a massive impact on your take home at the sale of your business, because the vast majority of your business is going to be taxed as a capital gain as it currently sits, typically 20%. If capital gains treatment goes away and everything's treated as ordinary income, every dollar you earn from the sale of your business could be taxed at 35 to 40%. So a meaningful change in tax rates if that were to occur. So fingers crossed that does not happen anytime soon. All right, so let's talk about DSO deal structures. And really, we're going to talk primarily about the holding company structure and the joint venture structure. But before we talk about the pros and cons of those two structures, which are the most common structures that DSOs are utilizing, let's just talk through at a high level each of these DSO deal structures. So traditional DSO deal structure, we don't see many of our clients sell under this structure. But what this means is, let's say the DSO is going to value your business. Strategic buyer typically is going to value your business at $2 million, and they're going to pay you, 1.3 million cash at close, and the remaining $700,000 of the value of your business, they're going to put on some type of holdback, earn out, where they're going to pay you in annual installments contingent upon the revenue and or EBITDA of your business remaining flat or better as it was at sale, and you fulfilling your post-closing employment obligation. So in a traditional DSO deal structure, kind of an old school DSO deal structure, there is no equity component. There's really no arbitrage, wealth generation component. And for that reason, because the upside is really capped, very limited, most of our clients, especially our younger clients, do not go after a traditional DSO deal structure. Moving on to a holding company structure. In a holding company structure, you're going to sell 100% of your business. You're going to take somewhere between, let's say, 60 and 75% cash at close. And the remaining value of your business, you're going to roll over into stock in the holding company of the DSO. So you're taking a piece of the value of your business and trading it for stock in the DSO's holding company. So in a holding company scenario, the equity you own is at the DSO level. So you're diversified across all the practices within the DSO. You own a little piece of every practice within the DSO. We'll talk about pros and cons of the holding company structure here in just a minute. The joint venture structure, and I would say that the joint venture and the hybrid structure are the two most rapidly growing structures that we're currently seeing in the DSO space. In a joint venture structure, you're going to sell 60 to 70% of your business typically for cash at close, and you're actually going to retain 30 to 40% of your business at the practice level. So compared it to a holding company structure, where your equity is at the parent company level, the DSO level, in a joint venture structure, it's a true partnership. You're actually retaining equity, stock in your own practice. So one of the benefits of retaining equity at the practice level is you could say that you have a little bit more control, over your destiny. And the value of your stock at recap, the value of your equity at recap, in large part is going to be predicated upon the performance not of the entire DSO, but of your specific practice. So we're starting to see a lot more DSOs implement a joint venture structure or a hybrid structure, where essentially it's a combination of the holding company and joint venture structure, because they understand that doctor turnover, in particular founder turnover, is their Achilles heel. And they want to align incentives not only at the DSO, the parent level, but also at the practice level. And the easiest way to align incentives with their partner doctors at the local level is to have those doctors retain some equity at the practice level so that they're incentivized to keep their foot on the gas at the practice level. The hybrid structure, again, a combination of the holding company structure and the joint venture structure. In this scenario, let's say you're going to take 60% cash at close. The remaining 40% of the equity in your business is going to be bifurcated between, let's say, 20% invested in stock in the DSO's holding company, and the other 20% joint venture retained equity at the practice level. So the hybrid structure is simply a combination of the holding company structure and the joint venture structure. When we talk about platform investments, when we talk about financial buyers buying a large multi-million dollar revenue, multi-million EBITDA business, possibly a multi-site, certainly a multi-doctor business, most private equity firms, most financial buyers utilize a holding company structure where they want the founders invested at the platform level. So you're going to hold stock at the holding company level. Typically, when you look to partner or sell to a financial buyer as opposed to a strategic buyer, an existing DSO. The last one I'll talk about is the roll-up concept. I'm going to get on my soapbox for just a minute. So there's a lot of people out there pitching, hey, join my co-op. I'm going to wrap my arms around, loosely affiliate a bunch of unintegrated practices and pretend like you're a real DSO. You're only worth 7 or 8 times EBITDA on your own, but if you join my co-op, we're all going to sell simultaneously to the same buyer for an exponentially higher EBITDA multiple. So where you're only worth 7 to 8 times EBITDA on your own, we're collectively going to all sell together simultaneously the same buyer at a 12 or 13 times EBITDA multiple. The reality is that private equity is not stupid. Private equity only pays for premiums for fully integrated, sustainable, scalable businesses. They're not going to pay a premium multiple and then have the responsibility of actually, one, closing all of those transactions simultaneously, which is a huge lift, but also integrating all of those practices and building real infrastructure to make the business scalable long term. The amount of time, energy, and capital private equity would have to spend to make that lift is enormous. They only pay a premium when you have actually done all of that work, which can take years to come to fruition. That's when they're willing to pay the premium. That's when they're willing to pay higher multiples. So I would encourage you to stay as far away as you can from the roll-up concept. Those concepts are set up to benefit, to profit the person who's running that co-op. They're going to charge you a fee to join. They're going to charge you management fees along the way. And ultimately, they're never going to bring you the unicorn deal that they've promised. It's going to be death by 1,000 cuts, raping you of fees along the way. And then if they bring you some sort of transaction on the back end, it's typically going to be at an EBITDA multiple that's synonymous with the current value of your business. So you pay a bunch of fees and you really don't get anything in return. So I don't like the roll-up concept. I think it severely limits optionality, and you don't really see the windfall that you're being promised despite all the fees that you pay along the way. So I'll get off my soapbox now and we'll talk about pros and cons of the holding company structure and the joint venture structure. So holding company structure. Pros, potential to obtain more cash at closing. So oftentimes holding company structures, especially if we're talking about a financial buyer purchasing a platform, they may pay 70 to 80% cash at close, and the remainder is going to be holding company equity at the platform at the DSO level. It also offers diversification, right? If you own a little piece of all the practices within the DSO, you are diversified. But that can be a double-edged sword, right? If the DSO owns quality assets, it's great to be diversified. But if the DSO owns, a lot of Class B, Class C assets, and you're one of the best practices in the bunch, I would say that exposes you to more risk rather than reducing risk through diversification. In a holding company structure, you have a higher probability of being able to liquidate 100% of your equity at recap, comparative to a joint venture or a hybrid structure where you're typically going to have to retain some level of practice level equity long term. So the cons of a holding company structure, there's really no clear line of sight into how the stock that you're purchasing in the DSO has been valued. And the way the holding company structure works is as the DSO goes through the recap cycle and gets more valuable and closer to a liquidation event, the value of the stock in that DSO is marked up over time. So if you enter early cycle, you're going to pay less for the stock typically than you would if you enter late cycle, purchase that stock. Because time value of money, right? The longer you're holding the stock, the higher your return should be. The lower holding time you have to a liquidation event, the more muted your return is going to be. So you will receive a muted return on investment if you enter the recap cycle late comparative to entering the recap cycle early. The other huge con of the holding company structure is that you're selling 100% of your business. You are selling 100% of your EBITDA to your buyer. So there's no ongoing pro rata EBITDA distributions as you would have in a joint venture structure. So you've got to think about, what is my annual burn rate, right? From a personal spending perspective. And am I going to be able to survive post sale on my chairside compensation? And if you've backed away chairside or completely stopped working chairside and you enter a holding company structure, your income's basically going to disappear. So is the cash at close going to be sufficient enough to support your living expense needs until you get to that second bite of the apple and the recap event? With a holding company structure, you could see the potential for higher return on your equity, but you're essentially betting everything on that second bite of the apple because you don't have any retained equity. You don't have any EBITDA distributions along the way. So briefly, I just wanted to show you how we model out deal terms. This is a 75-25 holding company deal structure. So with all of our clients, pre-market, once we get through the valuation process, we quantify EBITDA, we will oftentimes put together a cash flow illustration that shows if we fetch this valuation with this deal structure, how is this going to play out? Cash at closing, annually, and cumulatively, typically over a 5-year window. So we can do some modeling pre-market, and then once we go to market and we actually receive real live offers from buyers, we will plug those offers into this model and show you, based on this particular buyer, with where they're at in their recap cycle, with their deal structure, with the offer they've made to purchase your practice, this is how the economic implications are going to play out with some assumptions made over a 5-year period of time. So I won't go through this, line by line, but this essentially maps out how the 75-25 holding company deal structure is going to function over a 5-year period of time. So we map out revenue, we map out EBITDA, we map out cash at close, we map out the owner's chairside wages based on their post-closing compensation structure. We map out what their stock is potentially going to be worth at recap. And then we look at, annually, what does the cash flow look like? And then cumulatively, over a 5-year window, what does the cash flow look like? So a very, very powerful tool that we use with our clients to show you both pre-market, to educate you about the economic implications before you ever pull the trigger and start talking to buyers, but also on market as we receive real life offers and map out offer by offer financially so that you can compare apples to apples. So let's talk about the joint venture deal structure. This is where you're going to monetize, 50, 60, 70% of your business cash at close. And the remaining equity is actually going to be retained equity, joint venture equity at the practice level. So in a joint venture deal structure, it is a true partnership, which I would say will make you feel like you have more control in the sense that you still own a meaningful piece of your own business rather than owning a very small piece of all the practices within that DSO. The huge benefit, which is the huge con of a holding company structure, is that you get ongoing pro rata EBITDA distributions. So you're going to retain 30, 40% equity in your business, and therefore you're going to have the right to receive 30 to 40% of the ongoing EBITDA of the business. So rather than solely surviving on your chairside wage, you're also going to have EBITDA distributions that will help generate additional ongoing annual income for you. So for especially a lot of our younger clients that have a long runway before they exit their business, they love having some sort of joint venture equity component so that they're not solely dependent on their chairside wages to fuel their living expense needs. They're going to have meaningful EBITDA distributions along the way. And then the ROI at recap is not impacted by where you enter the recap cycle. So with a joint venture structure, irregardless if you affiliate with that DSO in year 1 of the recap cycle or year 4 of the recap cycle, you're going to get the full lift on the arbitrage at recap. You're going to receive the parent company multiple on your EBITDA times the amount of equity that you're liquidating at recap, irregardless of at what point you enter the recap cycle. So you can understand, if we're on market and we're representing you in a sale and we're entertaining offers from 10, 15 different DSOs and financial buyers, we're mapping out, where is each buyer at in the recap cycle? Where does your equity lie? Does it lie at holding company level? Does it lie at practice level? What are the implications of a recap with each forms of that equity? And when are each of those recap events projected to occur? So depending on the scenario, it could make a holding company model or a joint venture model more compelling, depending on who the DSO is at the table and where each of them is at in the recap cycle and what your rights are going to look like at recap. So modeling that out is critically important to understanding, how each offer, compares. The cons of a joint venture deal: there is very little diversification. Your equity is at the practice level. So if your practice performs poorly, your return at recap is going to suffer. But if your practice performs very, very well comparative to the other assets in that DSO's portfolio, you're not really going to see, major downside. But you don't have diversification in the sense that you don't own, holding company equity. You don't own a piece of a lot of practices. You're typically going to see lower cash at closing because in a joint venture deal structure, the buyer wants you to have a meaningful level of JV equity. So they're going to want you to have anywhere from, 30% joint venture equity at a minimum up to 49% retained equity in your own practice. You're typically not able to exit your joint venture equity in full at recap. The DNA of a joint venture DSO is that they want a doctor to have practice level equity. Now, you might be able to sell down your equity to 10 or 15%, but there's likely always going to be a baseline component of equity that has to be owned by a doctor. So at some point when you're ready to exit the business, you're going to have to figure out, do I retain that equity long term and step away from the business and have mailbox money associated with my ongoing pro rata EBITDA distributions, or am I going to have to sell that equity to another doctor? And then who is that going to be? Is that going to be an associate that's within your practice? Is that going to be, a third party doctor that's going to come in, buy you out, and step into that joint venture partnership with that DSO? So solving for that last piece of the puzzle, how are you going to divest yourself of your remaining joint venture equity, is probably the biggest challenge in a joint venture deal structure. Joint venture deal structures are also a little bit more complicated. So you need to understand, how is your joint venture equity going to be treated along the way? There's likely going to be a management fee that's charged by the DSO. What is that? It could be anywhere from 5 to 10% of revenue, and it might be negotiable. Is the DSO going to lever your practice with debt? We've seen some creative deal structures recently where the DSO puts the debt that they need to fund the transaction on the balance sheet and the P&L of your practice. And therefore, that debt is going to be serviced by the practice post-close, and it's going to severely erode the EBITDA distributions. There may also be the need for you to personally guarantee that debt, which is a massive amount of exposure and risk. We've seen DSOs that have put a ceiling on the recap multiple. Most of the time when you're a joint venture deal structure at recap, your proceeds are going to be predicated upon 3 things. 1, how much equity can you sell? 2, what is the EBITDA multiple that the parent company, the DSO, is trading for. Typically, you're going to receive that multiple, and then the EBITDA of your individual business. So what you need to think about is, how much equity am I going to be able to sell? That should be talked about at the initial transaction. What are your rights at recap? How much equity you're likely going to be able to liquidate? Two, are you going to receive the parent company multiple, or are you going to get some sort of muted return on that multiple whereby they would say, hey, we might trade for 12 or 13x, but your EBITDA multiple has a ceiling of 10x. And then third, is your EBITDA at recap going to be burdened by the management fee? And how is that going to impact your proceeds if so? So you've got to unpack all of this while you're navigating the initial transaction to understand, how is your equity going to function along the way? And then what is it going to look like when you get to recap? So many of our clients get so caught up focusing on, the initial valuation and the initial EBITDA multiple. They're not paying attention to all the other levers and details in these deals. And that's where, our job really comes into play, as well as, your attorney should be somebody that's well versed in DSO transactions, that's also watching out for all the fine print and making sure that you understand it, and then negotiate it if needed. So this is the cash flow illustration for a 60-40 joint venture deal structure. Again, mapping out revenue, mapping out EBITDA, mapping out the management fee along the way. In this case, it was a 5% management fee, but there is a strong likelihood we could actually negotiate a cap on this management fee and get it down to $120,000, $150,000 a year, which not only is going to increase your EBITDA distributions along the way, but also increase your proceeds at recap. And then we map out, how much net EBITDA is available to be distributed to the owners. Here's cash at close. Here's the return on that cash at close if you invest it at 5% growth per year. We've got the owner's chair side wages, and then we've got those joint venture distributions. So this is what's missing from the holding company model, because in the holding company model, you're selling 100% of the EBITDA. In the joint venture model, you're retaining a meaningful amount of EBITDA and equity at the practice level. So you can see ongoing meaningful annual EBITDA distributions post management fee. And then at recap, we assume that you sold 50% of your joint venture equity, $3.5 million payout at recap. And then the equity that you still have left, 20% retained equity, at some point, you're likely going to sell it to another doctor at more of a private buyer valuation. So we map out over a 5-year window, what does it look like at close? What does it look like annually? And then what does it look like cumulatively? And comparatively speaking to the holding company model, the annual income, because of those ongoing EBITDA distributions, is typically going to be higher in a joint venture model, lower in a holding company model, but the yield at recap is going to be higher in a holding company model comparative to a joint venture model. So you just got to think about who you are, what you care about, how your lifestyle is engineered, what your annual burn rate is from a personal living expense needs, and what deal structure makes the most sense to you. We typically encourage our clients not to have a predisposition as to what deal structure they want before we go to market. We typically advise our clients, hey, keep an open mind. We'll take the business to market and show you all the options. And what you think you want pre-market might change as you actually start to meet the people, receive the offers, and start to understand how all the components of these deal structures function. So I'll take a minute to talk about strategic versus financial buyers. Strategic buyers essentially are existing DSOs. They would buy your business on essentially as a bolt-on acquisition. So they already own, quite a few practices, and they're going to buy your business and integrate it and incorporate it into the larger DSO. The reason I wanted to touch on this is because I think there's a misnomer out there that Strategic buyers will pay a lower valuation for your business than financial buyers. Private equity, family office that's investing in your business as a platform investment. I don't really see that in the marketplace. So I wanted to make sure that we touch on this so you understand the difference between these two buyers and why the valuations are often congruent. Strategic buyers are typically bidding a lower EBITDA multiple on a higher EBITDA figure. The reason being is they've already built all the infrastructure. They don't need to build infrastructure around you, and they may not need to inherit all your infrastructure. So they're not going to burden your P&L with a bunch of infrastructural costs because they've already made that investment. That already sits on the P&L of the larger organization. Now, they might bid a muted multiple compared to a financial buyer, but they're likely bidding on a higher EBITDA figure because they can remove any of those infrastructural costs that a financial buyer is going to have to layer in. With a strategic buyer, you kind of know what you're getting. It's a little bit more predictable. An established DSO, you know who the financial sponsor is, you know where the DSO's been, you can follow their growth trajectory. We can talk about how many recaps they've been through, where they're currently at in the recap cycle, when's the next recap expected to occur, and have a little bit more predictability into the timing of that recap and what the return is going to look like. You're typically looking at a little bit shorter holding period to recap comparative to being a platform investment where it's going to be probably 4, 5, 6 years before you're able to monetize that equity component. But because you're likely entering mid-cycle when you sell to a strategic buyer, you're typically going to have a little bit lower return on the equity than you would if you were the platform investment for a financial buyer. Also, the larger the buyer is, the more practices they own, typically as the organization grows, the more and more muted the return is on the equity component. So financial buyers, if you're going to be a platform investment, you're going to be that platform that a private equity firm, family office, or some type of institutional investor is going to acquire and then build a DSO around your business. You're typically going to receive a higher EBITDA multiple, but they're going to be bidding on a lower EBITDA figure because you either have infrastructure in place that the buyer is going to need to inherit and then beef up to continue to scale the company, or you don't have the infrastructure, they're going to have to build it around you to actually make you a scalable, sustainable company. And they're going to burden your profit and loss statement with those infrastructural costs, which is going to erode EBITDA. So they're typically bidding a higher multiple on a lower EBITDA figure. So once you put pencil to paper, oftentimes the total valuation between strategic buyers and financial buyers are somewhat synonymous with each other. So it's kind of a misnomer that financial buyers will pay a significantly higher valuation than strategic buyers. Going with a financial buyer is going to be a little bit less predictable. You're not really going to know what you're getting from an operating perspective. Has that institutional buyer built a DSO before? If not, have they owned other, healthcare businesses where they were utilizing a buy and build strategy and then eventually exited those businesses? And if so, what type of business and what was the ultimate outcome? Also, if you're going to be a platform, oftentimes you don't know who is your financial partner eventually going to hire to be the CEO, the COO, the CFO of the company. What is the board going to look like? So a little bit less predictability in going with a financial buyer. Longer holding period to recap. I mean, if you are the platform, the clock on the recap cycle starts the minute you're acquired, and you're likely going to need 3, 4, 5, maybe even 6 years to scale the business to create the type of arbitrage and return you're looking for in the equity component, as opposed to with a strategic buyer. You may be entering in year 3 or 4 of a 5, 6-year recap cycle. You're only going to have to hold a year or two until a liquidity event. But with a financial buyer, given that you are on the ground level of forming that DSO, you're going to have higher upside but more risk on the equity component. So I thought it was important to kind of unpack strategic versus financial buyers, compare and contrast them. There's pros and cons of both. We typically encourage our clients, if you want to go to market, entertain both options. Just like you don't want to have a predisposition about deal structure, I also encourage you not to have a predisposition about what types of buyers you're entertaining. I would entertain offers from both strategic and financial buyers because you may have been of the mindset that you wanted to be a platform investment and sell to a financial buyer, but once you receive the offers, you meet all the people, you might realize that there's less risk and a shorter holding period, maybe more cash at close to go with a strategic buyer. So to talk through our proven DSO private equity affiliation process real quick, this is the blueprint for how we provide sell-side advisory to our clients, how we ensure that we create as much optionality and as much leverage as possible to ensure that, one, you find the right partner for your business. It's got to be the right fit. And two, we use competition among multiple bidders to drive the most favorable deal structure and to make sure we maximize the valuation, maximize the economic implications. We always start with a very informal, laid-back discovery call, confidential conversation just to get to know each other, unpack your why, right? What are your goals? What are you looking to accomplish? Learn a little bit about your business, how many doctors, revenue, EBITDA, number of locations, patient mix, payer mix, procedural mix. It's normally a 30-minute conversation to get to know each other and then figure out, all right, does it make sense to do a deep dive? Does it make sense to do an EBITDA analysis, to do evaluation, to quantify your options, and to do some of that economic pre-market modeling to show you, how it would look economically under various deal structures on a 5-year window. We can also do a no sales analysis so you can compare, what does it look like to just keep your head down and retain 100% equity in your business long-term comparative to pursuing a partner at this point in time. We give our clients completely unbiased, objective guidance. If now's not the right time to take your business to market, if you need to retool it, or maybe you're, on a awesome growth trajectory and you want a couple of more years of maturation to increase your revenue and EBITDA before you look to monetize the business, great. We'll hit pause on the conversation. We can coach you along the way and help you reverse engineer the outcome that you're looking for. Or if you want to go to market tomorrow, we've got buyers lying in wait, and we'll create a competitive process and make sure you find the right fit and maximize the economics. When we take the practice to market, the valuation conversation was a private conversation between us and you. We represent you. It's just designed to set a baseline expectation so that we know that economically our expectations are aligned, that we have a high probability of achieving a monetary outcome that's going to work for you. But when we take the practice to market, we utilize what we call a blind bid process. So we're going to put the practice out to bid. We're going to give the buyers access to all the information they need to formulate an offer. We're going to create a highly competitive environment. On average, our clients are going to receive anywhere from 7 to 15 offers. We're going to make sure we control the narrative regarding EBITDA. So many of our clients are focused on achieving the highest EBITDA multiple. In reality, the multiple matters, but the EBITDA matters more than the multiple. Every dollar in EBITDA is worth $7 to $10 in value. So controlling that narrative, making sure we're getting credit for all the add backs possible, making sure we're fighting any infrastructural costs that the DSO or financial buyer is trying to layer into your P&L to erode EBITDA and erode valuation. Manipulating EBITDA is the number one way that buyers manipulate value. So controlling the narrative regarding EBITDA, both pre-LOI and then defending EBITDA during the quality of earnings process, is a huge part of where we earn our keep. We're going to help our client interview and vet potential buyers. So you're typically going to have Zoom calls or in-person meetings or both with all potential buyers before they make an offer on your business. We give you a list of questions to ask, a list of discussion topics to be prepared to go over in those initial interactions with buyers. We're going to be there for those calls and meetings to shepherd you through those conversations. We're going to obtain and compare multiple offers. Again, that's where we go back to that economic modeling. We do the pre-market modeling to show you the economic implications under certain deal structures over a 5-year window. And then once we actually receive real live offers, we're going to go back to those models and plug in the real live offers that you receive and show you how they compare to each other so that you can actually do an apples to apples comparison and make an educated decision from an economic standpoint. We're going to determine what buyer is the right fit and then negotiate the most favorable deal terms with that particular buyer. Once we have all offers in hand, typically there's either going to be a clear front runner or 2 or 3 front runners. So we decide, are we going to negotiate with one buyer in particular or call for best and final among multiple buyers? Already mentioned that we're going to defend the EBITDA both pre-LOI and during the diligence process, and we quarterback the process from start to finish. If you need other advisors, if you need a good CPA, a good attorney, a good financial advisor, we have relationships with all those resources and can bring those resources to bear at the appropriate time. So we're really kind of your Sherpa, through this process. We're going to ensure that, one, you're educated before you ever pull the trigger and decide to go to market. And then 2, you're going to maximize your outcome if and when it's the appropriate time. So thanks so much for spending the past, I don't even know how long it's been, 45 minutes or so with me. I encourage you to schedule a discovery call, whether you're 3 months or 3 years or 5 years away from looking to monetize your business. The earlier we start this conversation, the better. You can text me at 512-660-8505 or email me at brannon@dentaltransitions.com. I also encourage you to visit our website. We've got a DSO transaction resource page that has a lot of webinars, a lot of podcasts, just like this one. Our website's dentaltransitions.com. Look forward to hopefully getting to know you. And Hilda, thanks for having me.
Brandon, as always, for spending time with us this evening. And thank you, everyone, for tuning in. Don't hesitate to reach out directly to Brandon if you have any questions or wish to continue this conversation offline. And before we head out, Brandon will be hosting an M&A workshop at our DO Summit, June 13th through the 15th in Orlando, Florida, where he'll go in depth on these topics and more. I did check our list this morning. We have about 20 seats left, so make sure you register as soon as possible if you want to get in. And I'll make sure to share the link in the chat box for those that are interested. Brandon, thank you again, and I'll see you next time.